Good afternoon, everyone. I welcome you all to today's webinar. We have with us Ms. Shilpa Wag, who will be leading today's webinar on personal finance planning for financial goals. This webinar is being organized under the Financial Education Initiative of the National Institute of Securities Market, NISM, which is supporting today's session. The NISM is a public trust established in 2006 by the Securities and Exchange Board of India, SEBI, the regulator of the securities market in India. The institute carries out a wide range of capacity building activities at various levels aimed at enhancing the quality standard in securities market. Before we begin the session, I would like to share few pointers with all participants. Questions will be taken at the end during the question answer segment. All participants will receive their certificates of participation in 3 to 4 working days. The recording of this session will be uploaded on the official NISM YouTube channel. Now, without taking much time, I would like to hand over the session our speaker, Ms. Shilpa Wag, ma'am. Thank you.
Thank you, Namrata ji, and welcome all to this session on planning your financial goals. I am Shilpa Wag. I am a CFP, Certified Financial Planner, and I work as a financial coach primarily in my company, August Catalyst Private Limited, and I'm also an adjunct faculty at NISM. I have been a SEBI registered investment advisor till 2021. So I have helped many families plan their financial goals so that their financial journey is intact. Taking some experience from those years, today's session I have designed in such a way that you can probably implement some of the tips that we are going to share today in this small session for you. Okay, so now let's begin today's topic, planning financial goals. Now, the first question is, what are we seeking? So, if you really think of it, everyone wants to have financial freedom. Now, what is the meaning of financial freedom? It can have different meanings to different people. Some would say that I should be able to travel the world the way I want to without bothering about earning money. Okay. Then some people may say that I want to follow my passion, right? I wanted to be a photographer, an artist, but because I have to earn money, I have to stick to my job. Some people may say that I want to own a house. If I have a house, then that is the fulfillment of my dreams. And of course, most of us wants to retire early so that we can enjoy our lives after that. But what exactly is the meaning of financial freedom? What we are seeking is whether we can be free from the day to day worries of our financial goals. Okay, that is what we call financial freedom. So, there are two approaches which are very important if one has to get financial freedom. What are these two approaches? Because we have seen that financial freedom can be achieved only if we can fulfill the life goals of our near and dear ones. Okay, so what are the two approaches we are talking about? The first is financial planning, okay, and the second is wealth management. Now, these terms you must have come across very often, and we are always confusing whether I need financial planning or I need wealth management. Okay, in my opinion, we need both. You need to plan. You are going for a travel. You first need to plan thinking where you want to go, how many days you want to go, how what budget you have assigned to that particular activity, and only when and how many people are going. All these things will give you clarity about the planning of the travel. And then comes the modality. Okay, now that I have decided which hotel to be booked, which airline to be booked, okay, which places to visit and how to book the tickets. Now, same way, when you say that I am going on the financial journey, we have to first plan how my financial life should look like. Now, that is financial planning. Once you have decided, so in primarily in financial planning per se, we do not start talking about whether I should invest into scheme A of mutual fund or scheme B of mutual fund, should I invest into PPF, NPS, how much money? No, we are not talking about that first. First, we start talking about what I want to achieve in my life, okay, and how much money will be required. If I am going to retire at the age of 58, what kind of retirement I would like to go for, okay, where I would like to retire. All these things, the planning part has to be done in financial planning. Now, once you have planned and you are ready with your plan, then comes the implementation of it, because only plan will not help you. How do I decide where to invest, how much to invest, which asset class is good for me, and who is going to monitor whether year on year the investments that I have done are yielding good results or no? That all will become the part of wealth management. So you can see both these activities are complementing each other. It is not either or, it is and. So you have to have financial planning and wealth management both, and that's how we will reach the financial freedom. So when we talk about financial planning, there are 5 steps which will give you a return on life approach. Okay, and there is goal based investment approach. These are the two approaches we have to follow. Return on life is the key word here. Okay, normally what we do whenever we think of investing, we only chase something called return on investments. Okay, but that is not all. Suppose you have got an investment where it is yielding you say 15% return. Okay, but what is the use of that investment if it is not able to fulfill some financial goal of your child, probably the higher education goal? Okay, so you are not going to be happy at the end of it. So what we are seeking is a return on life. So we will see what are the 5 steps we should get into in financial planning, and of course how to effectively do the wealth management by attaching each investment to a specific goal. So let us begin with financial planning steps. The first 2 steps are the most fundamental steps of financial planning. So before you move on to how to plan my financial goals, you have to get these 2 steps correct. Okay, you must have an emergency fund or contingency fund, as we call it, because calamity can come at any point of time. It can be natural calamity, it can be job insecurity, it can be health issue, it can come anytime, and that is the reason we have to have an emergency kitty in place. If it is not there, then definitely we just dig into our investments left and right, and then it only leads to financial chaos. So that is the reason we must have a contingency fund ready. Now, how much should be the contingency fund? So if you take your monthly expense, right, and your monthly expense, let us assume that it is around 25,000 rupees. For the next 3 to 6 months, you must be ready. So we normally advise at least 6 months of monthly expense should be your emergency fund. So 25 into 6, so around 1.5 lakhs is what we are saying should be emergency fund. That safeguards you from knee-jerk reaction to any problem that comes in front. The second step is risk planning or insurance planning. Primarily, we talk about life insurance and health insurance. Your life should be adequately covered so that, especially the breadwinners, so that even if unfortunately something happened to the breadwinner, the family still can continue with the financial goals as they had been decided. That's very important. If insurance is not adequate, all the financial goals and the planning is going to collapse the moment something unfortunate happens. And that's the reason if the breadwinner can have sufficiently covered under the life insurance. So your life insurance should be able to cover your dependent expenses, your children, your siblings, your parents may be financially dependent, correct? So the dependent expenses, plus if you have any outstanding loans that needs to be paid back, Okay, suppose you have taken home loan and suppose 20 lakhs is still remaining to be paid off. So that 20 lakhs will be the outstanding liability plus the day-to-day expenses for children and spouse. All these things should be considered while deciding what is my life insurance adequacy. And same is true for the health insurance. Even if your company has given you the health insurance, it is advisable that you have your own private health insurance for the entire family. So the floaters or some other way you can insure your family for the health insurance as well. So these two are something, they will actually make you ready for any kind of ups and downs in the life, correct? So first we have to settle these two steps. Only when these two steps are properly settled, then we go for the next step, which is called goal based investment planning, in where we will be talking about what goals do I have, what is the value of the goal, okay, what investment that I have currently can get assigned to a specific goal, is it achievable, or is there any gap between the money assigned versus the needed for the goal? All that discussion will happen in goal based investment planning. The next step will be retirement planning. Now, retirement also is a goal, it's a financial goal, but we normally take retirement planning as a separate goal because it is a different type of goal. See, most of the goals that we try for, whether it is buying a house, buying a car, going for an international vacation, sending the child abroad for higher studies, all these goals are such that once the goal is reached, you have accumulated the money required for the goal. That's the end of it. Okay. But retirement planning is something different. You chase a number called retirement corpus. So at the age of 58 or 60, when you retire, you must have X money with you. That is the retirement corpus. But once you achieve that corpus and you are at the age of 58, 60, that's not the end of it. That's the beginning of it, rather. And then you are going to get into the post retirement phase, and that money should last you till the last day of your life, which is we call life expectancy. So, this is why we normally treat retirement planning as a totally different goal altogether, because there is an accumulation and then there is consumption, and then we have to consider both. So, the time span, if you see, a 30-year-old person is doing the financial planning, he is going to retire at the age of say 60, and then the life expectancy is, suppose let us assume, is another 25 years, that is 85. So we are actually talking about 30 plus 25, 55 years is such a large time that we are talking about. There will be so many ups and downs of inflation during that cycle, and so we have to be very precise and very careful about retirement planning. So that is a very important financial goal which you have to consider and start preparing for it. And of course, the last is the estate planning or transfer of whatever inheritance you want to pass on to the next generation. When all these five steps are taken care properly, then you are on a right steps towards your financial freedom. Okay. And second is wealth management. We will have multiple assets in our portfolio. Okay, we know major assets. We'll have a look at it in a brief way in today's session itself. But you are the multiple assets are like equity. It can be fixed income like FD, PPF, national saving certificates, or it can be gold, it can be real estate. And we want the combination of all this in a right proportion. And what will decide the right proportion? We are going to talk about the time horizon, because we want to link all this investment to goals. And goals will have a specific time duration to achieve. Correct? Some goals will be short term goals, which are happening in next 2 to 3 years. Some will be mid time goals, like 3 to 7 years. And some will be long term goals, which are beyond 7 years. So, depending on the time frame of the goal, depending on your own risk taking ability. Okay, suppose you have invested 100 rupees and suddenly the market crashes and that 100 rupees starts showing you now your worth is only 90 rupees. How easily can you take that notional loss of 10 rupees? Okay. Or you are still comfortable even if it comes down to 70 rupees. Okay. That is your risk appetite. So that will define which type of investment you will get into. And of course, the tax treatment. Some of the treatments will be irrespective of your income slab, like equity, but most of the investments will be as per your own income slab. Correct. So, all these things are considered when you are actually defining which investment I need to invest into. Now, with this background, so now we know that whatever financial freedom I want to achieve, I must have financial planning done properly, and I should also have the wealth management done properly, and they go both hand in hand. So, now let us see what are the steps for planning for financial goals, right? First step, wherever you are going somewhere, you should know where you are at present. Okay, so as is study is the must. So what is the as is study? Where am I financially today? Most of my clients have now and again always used to tell me that this one exercise itself give them lot of information about their own financial health. Okay, otherwise we do have investments, but they may be scattered in such a way that we don't have them written down in a proper way in a specific place. So this exercise will help you understand where is the money coming from, what are the different sources available for income. Okay, you may be a salaried person, a business person, you may be having a house which you have given on rent, you might be having some agricultural land and from there you are getting some income. So all this information you will write in the income part of it, and in Excel you can very well generate this. You don't need a special software for this, isn't it? And so then in the expenditure, now this is very important. Okay, as I told you the 5 steps of financial planning, we spoke about the contingency planning, correct, which depends on the expenses. We spoke about the insurance planning, again that depends on the expenses. We spoke about retirement planning, that also depends on the expenses. So writing expenses is very important for a proper financial plan. Please consider the bifurcation of expenses that are shown on the screen. There is household expense, lifestyle expense, dependent expense, insurance premiums, and loan servicing, or EMI as we call it. Now, out of this, except for the lifestyle expenses, most often rest all are mandatory expenses. Okay, so household expense, dependent expense, insurance premiums, and EMI are mandatory expenses. Now, what is the meaning of this? Irrespective whether you earn your salary or you don't earn your salary, these expenses will be incurred. Okay, and so you have to be ready for them. Lifestyle expenses is something which one can do the budgeting part of it. They can reduced, they can be checked upon. If you feel that I'm spending too much, then lifestyle expenses is something you have to go for. Second information that you have to collect is what are your investments. Okay, so there are investment assets. You will have some savings account, you may have some cash in hand. They are your liquid money. Liquid is it's immediately available, so it is liquid money. Then there is debt side. Now debt, don't let us not confuse ourselves with the word debt. Is not loan here. Debt is investments which are giving you fixed interest, like fixed deposits, national saving certificates, Kisan Vikas Patra, senior citizen savings scheme, okay, or your retirement benefits, that is EPF, superannuations, okay, debt mutual funds, all that will come, or traditional insurance policies like endowment policies, okay. So all those will come under debt. Then equity, of course, the stock market, either you have invested directly or through equity mutual funds. Gold will come in the picture, okay, and real estate. Now, while you are writing your investment assets, just make sure in real estate, do not include your house in which you are staying, because that is your house which you are using for staying purpose. That is not your investment asset. Investment assets should be, how do you define investment assets? Investment assets are those which can be sold. if the need be. So you are of course not going to sell your house in which you are staying, and so you will not include it here, right? So these are your investment assets. And the next you can find out is your net worth. How do you find the net worth? So these are your assets that you have already listed, all the investment assets. Plus there are personal assets. So as I mentioned, the house in which you are staying, that is your personal asset, your vehicles, jewelry, etc. Okay. Then there will be liabilities. If you have home loan, education loan, car loan, all that will be listed. And how do you come to the net worth? Your investment assets plus your personal assets minus your personal liabilities. That will give you your net worth. Why is this information required? This information will be required because one, you will accumulate all your financial data in one place that will prepare you in a better way. And second, very importantly, it will give you certain facts. So we spoke about income and expenses. Why is it required? So there are some thumb rules which you should remember. Okay. So when we talk about expenses, what is the thumb rule? The household expense, lifestyle expense, and the dependent expense should not be more than 35%. Okay, that's the thumb rule. Another thumb rule is your EMI. If you are earning 100 rupees, not more than 40 rupees should go towards EMI. Correct? And if you don't have this balance, then it affects your investable surplus. Now, what is investable surplus? You want to do investments, you want to become rich, you want to become financial freedom. But what if there is no money left after you earn and after you spend at the end of the month? Correct? So, how much should be your investable surplus? Now, these are thumb rules. That doesn't mean that you have to have 25%. If it is more, nothing like it. Okay. But if it is less, then there is a scope for some introspection to understand where I can save more money. So either you can save money, that is reduce your expenses, or you need to find out if you can increase your income. Okay. So either way, your focus should be to improve your investable surplus. So that is one parameter which will be identified when you will write all the data in one place, which is very important. Second is your assets and liabilities. Why are they important? If you remember in the last slide, we came out with the net worth. Obviously, your net worth has to be positive. That means your assets should always be more than your liabilities. If it is the other way around, that means you are asking for trouble. That means your liabilities are more. More loans are outstanding than your asset value. Now that's a problem situation. So this will help you understand your financial health today. It will also help you understand your financial habits. Okay. And that all is required when we go further. Okay. Fine. So you have done the as is study. Now you have to find out what are my life goals, what all I want to achieve. So most often, people have these goals like I want to buy a home, I want to buy a car, children marriage, or your own marriage. Okay. Then foreign travel, domestic travel, retirement. These are the goals. But you have heard about a statement called SMART goals. Okay. And what are SMART goals? They are nothing but they are specific, measurable, attainable, reachable, and trackable. Okay. They are SMART goals. That means we have to quantify. At the end of it, we have to quantify how much is required. For example, if I want to buy a house, it's not enough to say that I want to buy a house. Where do you want to buy a house? When do you want to buy a house? Okay, so the statement should be I want to buy a house in 2027 in, say, local suburbs of Mumbai, correct? Western suburbs of Mumbai. How big is the house? Maybe I want a 500 square feet carpet house. So how much it will cost as of today? Let us say that it will cost around 1 crore today. Okay. Now that gives me a very specific statement. Okay. Because I know the time, I know the cost, and I know the location, then I know the appreciation of the value. Okay. So this makes it a SMART goal and I can track it. because now there is quantifiable, I can track it. Correct. So what you should do, you should write down all your goals, make them specific, measurable, and then we will see how to go for attainability and trackability. But first, at least the two steps, the specificness and the measurability, all these two things you have to go for. Maybe you can uh, create a chart like this, put as of today where we are, say 2024-25, we are in that. So in 2025, suppose I want to do the car purchase, my child's graduation will come in 2037, post graduation will come in 2041, marriage will happen in 2045, and my retirement will come in 2046. And then after that, 25 years more is my life expectancy. So I am likely to survive till 2071. Now my wife is probably 4 years, 5 years younger to me, and she is also saying 85 years of life expectancy, so she is likely to survive for 2075, 76. Now this is a lifeline or timeline for your goals, but this has got only one specificness, that is the time. What about the value? So we should attach value to it as well. Okay, so as of current, so since I have taken 2024 as the starting point, what is the value for each goal in 2024? That is what I have written. Okay, that's the current value. So for car purchase, I need 5 lakhs. For graduation, 6 lakhs. Post graduation, 15 lakhs. Child's marriage, 10 lakhs. And retirement, 75 lakhs. That's what I envisage. But we have to always remember there is a spoil sport called inflation. And these values are not going to remain the same by the time you actually come to the goal time. Okay. So we all know that whatever we used to spend money in 2009, in 1990, today we are spending much more than that, almost 10 times more. Okay. That means the inflation is going to affect the expenses. Your expenses this year and the next year will be different. Next year, even if your lifestyle and everything remains the same, you will be spending more money than this year. Okay. This is called time value of money, which is a very important concept in financial planning. Correct. We have to remember that purchasing power of rupee goes down and cost of living goes up. This is very important. Correct. Now, what is the meaning of purchasing power of the rupee goes down? Suppose somebody has given you gift. When we were small, elders used to give us say 50 rupees, 100 rupees, 500 rupees as gift on Diwali. You have kept this 500 rupees in the cupboard. 2 3 years down the line, when you were cleaning your cupboard, suddenly you got hold of that 500 rupees. Now you are very happy that you got 500 rupees and you go out to purchase something. Now, whatever you would have purchased with this, that 500 rupees 3 years back would be much more than what you can purchase today after 3 years, right? Why? Because the things have become costly. So, suppose in 500 earlier you would have purchased 10 pens, but today you can purchase maybe only 6 to 7 pens because each pen has now become more expensive than earlier. In other words, the purchasing power of that 500 rupees has gone down. So we have to remember this time value of money when we talk about financial goals. Okay. So what you have to do, not only that you have to come out with the current value of the goals, you also have to do some calculations about what might be the future value of the goals. Now there are some scientific ways or proper calculation ways of doing the future value calculations in Excels. Okay, you can search, those who are interested can search is equal to FV, which is the future value function. But those who are not want to get into it, you can use some thumb rule or your gut feeling, but you must know that it is going to go up, right? So probably the graduation for the child, instead of 6 lakhs, by the time 2037 comes, maybe I have to be ready with the 10 lakhs. For child's marriage, maybe I have to be ready with 20 lakhs. And for my own retirement, instead of 75 lakhs, maybe I have to be ready with 2 crores. Okay. Now, this is more important number for us. Correct? Because what I am chasing, I am not chasing the current value. I am chasing the future value. So by the time 2045 comes, when the time for child's marriage comes up, I must be having 20 lakhs. I cannot chase 10 lakhs and say that, oh, I have 10 lakhs, but now the expenses are 20 lakhs. So what I am chasing is 20 lakhs, correct? So that is very important for us. Can we beat it? So this is where the goal-based investment come in the picture. Okay. So the third step you have to do is, you already have as a study, you know what all assets you have. You have done the calculation of your timeline where you identified and made the goals specific and measurable. Now you have to see which asset can get assigned to which specific goal. Okay, this assignment is very important to be on track and to be disciplined. Okay, so allocate the current asset to the goal. So for example, you have a FD for 5 years, right? So which is going to mature in next 5 years. And then there is a goal which you are going to go for in 5 years time. Probably you will say that, okay, whenever this particular FD will mature, I will use that money for this specific goal. Okay. That is called allocate the current asset. Now, very important step, check if the goal's inflated value is achievable. As I said, for the marriage, 20 lakhs is more important, correct? Now, you have assigned the asset. The asset is increasing at a specific rate, whatever is the rate of interest that particular investment is getting. Expenses are also growing at the rate of expenses, that is the inflation. At the end of it, suppose you do the calculations and you realize the allocated asset will only give me say 14 lakhs by the time the marriage time will come for the child. Whereas my requirement is 20 lakhs. That means there is a gap of 6 lakhs. Now I have to start working towards filling this gap of 6 lakhs. That is the plan you have to create. Okay. So maybe every month you have to start an SIP or some other RD, recurring deposit, whatever is the asset class you have to choose, and I have to continue that till the goal is achieved, right? So that the 6 lakhs gap can be filled up. That is what is financial planning. Identify the goals, identify the current assets that can be assigned to the goals, find out the gap, do the proper investment in a disciplined way, and the goal is achieved. That is the role of financial plan. But what if it is just not possible to reach the goal? Okay, because the resources are limited, you have other goals also to achieve. Okay, so if it is not possible to achieve the specific goal of 20 lakhs, then what to do? There are three ways. One, reduce the cost of the goal. So suppose you had planned that the marriage will be done in a specific way, which will be costing me 10 lakhs as of today. Can I change it so that the costing becomes say 7.5 lakhs? Okay, that's one way. Second, delay the goal. So instead of 2045, suppose I delay it by another 2 years, will I be able to manage to get that kind of money in place? That is the second step you will take. And the third is prioritize the goals. So, of course, not with child's marriage, but there can be some other goals like going for international vacation or buying a more luxurious car. Can I do the prioritization of the goal and skip those goals at all? Because they are taking too much of my investable surplus. See, here the investable surplus comes in the picture. Because if you do not have enough money at the end of the month, what will you invest? That's why more the investable surplus, more the possibility that you will be able to achieve your goals. Okay. And once you have identified how much money I need to invest, depending on the time horizon of the goal, your risk appetite and the tax treatment, you will decide which investment class I must select. Okay, just an example. So there is a current value of the goal, future value of the goal, and then with the inflation and the time frame, you will do that calculation. You will have some current financials plus you will have some additional investment so that you can achieve the future value of the goal. Example I am giving you, suppose I want to buy a car, okay, in 2030. its current value is 5 lakhs. The inflation is 8%. So the future value of the car becomes 7,34,664. Which asset I would like to assign to this? Okay, there is an FD of 3 lakhs maturing in June 2025. Okay, so those 3 lakhs I would like to assign to this specific goal of purchasing a car. Let us see the calculations. So the current value is 5 lakhs of the car. With the 8% inflation in 5 years, it is going to cost me 7,34,664. So this is the future value. I should be ready with this value. My current FD is reinvested. So what is the value of the current FD? 3 lakhs. I am reinvesting it for the next 5 years. So at maturity, this 3 lakhs is going to become 4 lakh 1,467. Now 7,34,664 is the value I need. I am ready with 4 lakhs only. So that means there is going to be a gap of 3,33,196 at the time of the goal. I have to do something about it. So what I have to do? I have to start investing around 4,775 every month. Okay. So if I say that, okay, I will select a investment, maybe RD, recurring deposit I will select, which will fetch me 6% post-tax return, and I will start investing around 4,775 every month for the next 5 years. If I do that, I'll be able to make up this 3,33,000 gap. And that's why at the time of the goal, I will have required 7,34,000. Okay. This is how we do the calculations. The next question, now you are very clear looking at this that how much I need to invest month on month. Okay. Your clarity should be achieved for each of your goals. But now the question is where to invest. How do I know? So you have to understand what is your risk tolerance. So as I said, your invested money is 100 and because of the market crash, suppose it becomes 90, what is your reaction? If it becomes 80, what is your reaction? Okay. So you should be able to classify your own risk tolerance, whether you are an aggressive investor. Aggressive investors are those who are ready to take the risk. Conservative are the ones who are risk averse. They don't want to take the risk. And then there are balanced who are like, they are okay with some risk, but not too aggressive. Correct? So once you have identified this, then you know which investment to invest into. Okay. So this is just a suggestive distribution. This is no way recommendation. Okay. For example, because I am aggressive, I will give more weightage to aggressive asset class, growth asset class like real estate, equity. Okay. If I am balanced, maybe 50%, I'll reduce the proportion. If I am conservative, maybe I'll give only 35%. Now you have to identify what is the correct mix for yourself. Correct. So how much money should be invested into gold, how much money should be invested into growth assets, and how much should be invested into the fixed assets. Now the thing is, one thing is for sure, though this proportion is up to your calculations, if you want stability for your portfolio, definitely some amount of your portfolio you will have gold investment. For long term goals, which are like 7 years and beyond, 7, 8 years and beyond, you can go for class like equity. But for medium and short term goals, you should have fixed income related instruments in your portfolio. Okay, like recurring deposit, national savings certificates, fixed deposits uh, from the nationalized banks or with AAA rated fixed deposits. All these will be there for your short term goals and medium term goals up to 5 years, 6 years. Correct. So if you want to buy a car in 5 years in our example, you should not start investing into equity mutual funds because it is a medium term goal and you don't want to take the risk. Okay. But your child's marriage is around 18 years or 20 years down the line. Definitely you can go for equity kind of an asset class. So these are the proper asset classes that we talk about. Many aspects are there, plus and minus for everything. Like for example, fixed income gives you the stability, gold gives you the stability, but equity and real estate do not guarantee you any kind of appreciation, and so they are more volatile or more risk oriented, and so you have to be very clear where I should invest and how much I should invest. Okay. Three parameters: what is the post tax return each asset class will give me, the safety, okay, the stability, safety in the sense the stability, okay, and the liquidity. For example, uh, let us take that you have a real estate, okay, you have a house and that is worth 1 crore of rupees and you are in need of money. Now obviously you want money to come quickly because the need is like, I want to give some 25 lakhs in a span of 10 days time. It's very difficult to sell real estate in 10 days and generate that money. Secondly, it is not divisible because I want only 25 lakhs. So for 25 lakhs, should I sell a house worth 1 crore? That is also not correct. So liquidity wise, real estate is a very poor kind of an asset class. Against that, if it is equity, if it is gold, or if it is fixed income which is not under locked in or something, probably they are more liquid. Okay. But safety wise, definitely some people prefer physical asset classes. So real estate and gold are physical asset classes. So I might select real estate because I can see it, I can feel it. Gold, I can see it, I can feel it if I take the real gold. Okay, the physical part of it. Gold, of course, is possible to buy in paper gold also, like mutual funds, ETFs, they are available. So you have to understand every asset class will have certain characteristics and they should be tested against the time horizon, your own risk appetite, the tax treatment, the safety, whether there is a regulator, okay, the liquidity. These are some of the characteristics you have to understand before you invest into all these asset classes. One thing is clear, there is nothing to beat equity, though it is having certain risks due to the volatility attached. But if you really see the parameter from 1990 to 2020 also, you can see how equity has actually given around 14-15% returns year on year, okay, as against the fixed income. So your portfolio, you should never say that I don't want to invest in equity at all. Okay, you must think about this for the long term goals. You can try, right, depending on your risk profile. If you are conservative or balanced, you can go for more on the large cap funds, index funds, okay, which are investing into large companies so that there will be little less volatility. If you are more aggressive, maybe then you can go for small cap funds or flexi cap funds or thematic funds, but only if you are aggressive, right? So you can decide, but you cannot totally say no to equity. So you should have combination of various asset classes in your portfolio. As I said, retirement is another very important goal and that has to be treated separately. Okay. You have to do the calculation of your retirement corpus. How much retirement corpus is sufficient? I'm just giving you a very quick kind of a case study for your simplicity. See, wherever you are today, whether you are at the age of 30, 35, 40, wherever you are, calculate what is your current annual expense. Okay, so in this case, the total annual expense as of today, the step one as it is shown on the screen is 3 lakhs. Okay, now the person is 39-year-old. So his retirement is as the age of 60. That means 21 more years to go for the retirement. Correct? So because of inflation, we have discussed this. Because of inflation, this 3 lakhs will not remain 3 lakhs next year. It will increase. Like that, it will keep increasing till the end of 21st year. So in the 21st year, that is the first year of retirement, what will be the amount this person will be spending? So 3 lakhs of today with 7% inflation are going to become 12 lakhs in the first year of retirement. Okay, so now from 39 years, we have calculated his expenses at the age of 60. Now, this expense he is likely to incur every year till the time of life expectancy. Again, the expenses will grow because of the inflation. Okay, but his investments will also grow at some rate. So normally what we do, we try to nullify this effect. So expense is also growing, investments are also growing. Okay, so if we do that overall calculation, he must have 2 crores of rupees at the time of retirement. We call it retirement corpus. Okay, now one thing to remember, retirement corpus, this is only the day-to-day expenses. We have to add the medical emergency kitty to it, though we have health insurance. Okay, for the important goal of retirement, we have to have medical expense kitty separately. And in the retirement, you may think that, okay, I want to do some charity work. I want to, donate some amount for some spiritual cause, social cause. I want to, give money in my village for the school. So such aspirational goals will be there. For that as well, you will keep aside some money, right? So your retirement total corpus will come out to be your day-to-day expenses, the way I have shown you the calculation, plus whatever medical kitty you want to keep separate. Okay, from today onwards itself, you can keep aside some money for the medical expense. So even if you have health insurance, you have your own medical kitty which will be used for all those expenses which will never be covered under health insurance. Correct? And third will be your aspirational goals, whatever you want to achieve. So retirement will obviously have all these aspects in place. We have to be very careful about retirement planning, and that is because we have seen how many years we have taken. 20 years in retirement, suppose we have taken here. Okay, so from 60 his life expectancy is 20 years. There is a big assumption of 7% here. Now what happens if this 7% becomes 8% or 9%? Obviously this corpus will not last for 20 years. It will last for less number of years. Okay, so that's the reason we have to be very careful. Excuse me. You should start investing towards your retirement from the first pay, from the first salary. People normally say, I have just started my career, my retirement is far away. That's not the case. Please start at least 10% of your income, let it go to this. And as and when your income will grow, you add more to it. Where will you invest? Where will you invest towards retirement? Excuse me. Obviously, public provident fund, employee provident fund, national pension scheme, various mutual funds, stock market, and pension policies. Okay, so these are some of the building blocks towards your retirement corpus. So what all we have covered now, we have said that financial freedom is possible only if you do financial planning and wealth creation, that is wealth management, hand in hand. Financial planning, 5 steps: contingency planning, insurance planning, goal-based investment planning, retirement planning, and estate planning, and a proper mix of assets as per the goals. Sorry. So that is what I want to cover. Excuse me. So if you have any questions, the forum is open for the questions. Let us see. So there is a question which is asking, like, I bought a flat and I got 20 lakhs loan. What is the amount of SIP I can select? Okay. Now the thing is, as I said, your decision making will depend on 3 factors. One is, what is the repayment of this loan that you have taken? What is the time horizon? Secondly, what is your risk appetite? Because depending on your risk appetite, you will have to select the correct SIP. So if your repayment is due only in 5 years, I don't think you can go for SIP, but definitely if the repayment is over the period of 20 years, that is long term, you can go for SIP. What else? Can we get the expenses? Yeah, you can definitely use Excel for the expenses. The question is whether I can use Excel. Definitely. Is there any tool for financial planning? So there are many tools available, but if you really see, it's a matter of just calculating it on the Excel. So definitely you can check on the Google if there are any tools available. My suggestion will be you just use Excel because it completely is in your own hand to do all the calculations. There are financial calculators available in Excel. As I said, future value, present value, the payments, that is the SIP calculation. All this can be done in Excel. Very easily it can be learned. Somebody wants to get into the financial planning activity, of course, that is not pertaining to this session, but definitely you can go for NISM Advisor 1 and 2 exams, or you can do CFP. That will be very helpful for you. At what age we should stop investing into equity and keep our investments in debt fund? Now, I don't think there is any age, okay, because there are many people who give you the thumb rule like 100 minus age. So if you are say 40 years of your age, then 100 minus 40, that is 60% should be in equity. But my experience shows that it all depends on what is your knowledge about the stock market, what is your risk capacity. So we have been talking about risk tolerance, okay, that is aggressive, moderate and conservative. But there are certain risk capacity parameters, like suppose you are a very wealthy person, correct, you may have a better risk capacity if your knowledge about the stock market is very good. You have been doing it all throughout your life, you have been following it, and you believe in finding out good stocks, correct. So I have seen at the age of 80, 85 also, people are quite heavily invested into equity and they know how to handle it, but they have a backup plan. They have good amount of money kept aside. So if market crash happens and it takes 3 to 5 years for the market to revive, they are not panic and they have the holding capacity. So one can get into equity at any age, not a problem at all. But as I said, the backup plan has to be there. Okay, if you want to use any tool for maintaining your expenses, the expense records are available. Expense recording tools are available in the on the market. In the market, some free apps are also available. It is very important that you do it. Okay, whether it is app, whether it is Excel sheet or on a piece of paper. Of course, Excel and other tools will help you to do the analysis of your expenses in a more better way. So you can go for it. Okay, how is real estate risky and volatile asset? Now, first of all, whenever we talk about any asset class, we talk about few parameters, as I mentioned in my presentation also. We talk about whether it is having any regulator, whether it is having the liquidity, whether it is volatile. Okay. Now, if you really see, the real estate depends the value of real estate. There is no transparency. Like if you compare, say, equity. Now, equity, there is a regulator called SEBI which controls the how the entire market works. So, suppose there is a company XYZ and its share is purchased today. Okay, today morning, suppose 10:30, I purchased a share and somebody else also purchases the same company share at 10:30 in some other location, okay, we both are going to get for the same price. Now that is the transparency, and then there is a control over the pricing which the regulator has. Unfortunately, in real estate, we do not have such pricing regulator as of today. You might have seen that in the same location, same building, same floor, two flats will be sold at two different prices. Okay, so that is the kind of risk one attaches to it. The risk is not only because of the money part of it, the volatility part of it, the risk is also because of the liquidity part of it. Correct? So there are so many other parameters, how the location of that particular real estate is developing. There can be n number of such parameters which are uh, affecting the riskiness of that particular asset class. So if somebody has the salary under 20,000, how much percentage of salary you should save for the investment? So as I said, as a thumb rule, 25%, which becomes 5,000. Now, because the salary is below 20,000, 5,000 may become little too much, but you can start small. But let the equation be, I get the salary, I keep aside this 2,000 as my investment, and remaining 18,000 is available for the expenses. So try to keep that as an equation so that you save first and then spend, and not like I get the salary, I spend first and then I save. That will not help you in getting the proper investable surplus. And as your salary will grow, or as you can monitor your expenses probably in a more efficient way, maybe this 2,000 can get into 2,500, 3,000, and like that you can increase your investable surplus. As far as investment in gold is concerned, I think it is better that you can go for the paper gold, because physical gold, again, the problem comes about the purity, the safety, etc. So I think we have taken enough questions. The time is almost running out. Okay. So I hope in today's sessions you have understood the way you can start your planning for the financial goals. And thank you for attending the session. And Namrata ji.
Thank you so much, ma'am, for such a wonderful and informative session here. We truly appreciate your time and the valuable insights you have shared with us today. Also, a big thank you for all participants for attending this webinar, and we hope you found the session useful. Thank you all.